Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about LONGFOR GROUP Holdings Limited annual report. LONGFOR GROUP Holdings Limited offers a diverse range of businesses and services through its three main segments: property development, investment property operation, and property service. The company's property development segment involves developing and selling office and commercial premises, as well as residential properties. This includes a variety of property types such as shopping malls and rental housing. In addition to property development, LONGFOR GROUP Holdings Limited also engages in the leasing of investment properties through its investment property operations segment. This includes shopping malls and rental housing that are leased out to tenants. The company's property service segment provides property management and related services, including managing hotel properties. This comprehensive range of services makes LONGFOR GROUP Holdings Limited a significant player in the Chinese real estate market. LONGFOR GROUP Holdings Limited market capitalization of 53 billion is significantly larger than the average industry peer of roughly 5 billion. This shows that LONGFOR GROUP Holdings Limited holds a significant advantage in their industry. LONGFOR GROUP Holdings Limited trades at a higher price-to-earnings ratio of 46 times and a lower price-to-book ratio of 0.29 times relative within the industry. While the stock does not screen as absolutely cheap, mixed valuation signals relative to industry peers prevent a definitive conclusion. With the broader industry trading at lower valuation levels, this may reflect transitional pricing dynamics rather than clear mispricing, warranting further analysis of earnings quality, growth sustainability, and balance sheet strength. The leverage on the balance sheet appears elevated, with liabilities of 63% of total assets. This raises some concern, and we should examine the industry and nature of the business to determine whether they justify the elevated leverage. Average liabilities have declined over the past 5 years, indicating improving balance sheet discipline and reduced financial risk. Shareholder equity has grown consistently, but operating income growth is weak or inconsistent. Equity expansion may be driven by financing activities rather than core business profitability. Although shareholder equity has increased, the share count has risen while revenue is declining. This raises concerns that equity growth may be driven by dilution rather than business performance. The sustainability of the business model remains unproven. The company have a dividend yield of 2.45%. The income statement shows that the company revenue have been declining annually and operating income have not been increasing. This shows that the business is under pressure with rising cost and its management is unable to expand the business. The primary drivers of revenue growth or decline in the company's financial performance can be identified through an analysis of various key indicators. On one hand, rental income has shown a modest increase of 3%, indicating a stable source of revenue. Additionally, valuation gains from investment properties have contributed significantly to the revenue, amounting to RMB 4.7 billion. However, on the other hand, property development has seen a decline of 30%, which is a significant contributor to the overall revenue decrease. Contracted sales have also been affected, with decreases in Western China, Yangtze River Delta region, and Southern China, but an increase in Central China. Rental housing has shown a slight increase of 4%. The drivers of revenue decline include increased costs such as cost of sales, staff costs, and minimum lease income from investment properties. The net income of the company decreased by 1.3% due to various factors affecting its operations. On the other hand, profit margins showed a mixed trend across different business segments. The gross profit margin increased in property operation business by 1.4%, commercial investments by 1.8%, and asset management by 0.2%. These improvements can be attributed to several key reasons. The company's efforts to reduce inventory levels and align with market demand have contributed significantly to the increase in profit margins. Additionally, operational discipline, prudent sales volume and pricing management, and continuous improvements in delivery execution and service quality have also played a crucial role in achieving these results. The company's financial performance has been a subject of interest, and one key indicator that suggests its stability is the generation of positive operating cash flow. This means that the company is able to generate more cash from its core operations than it spends on various activities. A closer look at the company's financial statements reveals that this trend has continued for 3 consecutive years. According to page 19, the company has reported positive operating cash flow after capital expenditures for each of these years. This consistency in performance is a testament to the company's ability to manage its finances effectively and generate sufficient cash from its operations. The generation of positive operating cash flow is a crucial aspect of a company's financial health, as it indicates that the business is able to cover its expenses and invest in growth initiatives without relying on external funding. This trend bodes well for the company's future prospects and suggests that it is well-positioned to continue delivering strong financial performance. The company's debt levels and interest expenses have undergone some changes over the past year. While the consolidated total borrowing decreased by RMB 23.51 billion to RMB 152.81 billion, other metrics show a more complex picture. Total debt saw a decrease in current liabilities of 46.5%, but an increase in non-current liabilities of 3.4%. Meanwhile, consolidated total liabilities increased by 11.6%. In terms of interest expenses, the average finance cost rose to 3.51%. However, specific interest expense figures are not explicitly stated for all categories. Interest expenses on financial liabilities at FVTPL decreased, while those on lease liabilities and bank and other borrowings increased. Notably, interest expense on senior notes decreased by RMB 57,833 from RMB 449,844 in 2024 to RMB 392,011 in 2025. Overall, the changes suggest a nuanced picture of the company's debt levels and interest expenses. The performance of various segments and regions within the company has been mixed. On a positive note, property development saw contracted sales of RMB 63.16 billion, while property operation and property service reported positive segment profits of RMB 8,837,682 and RMB 4,892,022, respectively. Commercial investment also experienced a 4% year-on-year increase in rental income. The long-term rental apartment brand, Goyu, achieved a remarkable 94% occupancy rate and generated RMB 0.48 billion revenue, while the dynamic commercial pedestrian precinct brand, Hybrid Space, maintained an average occupancy rate of 93% with 4 new projects opened. Additionally, property management service saw significant growth through LONGFOR Intelligent Living, generating RMB 11.23 billion in revenue. However, some segments and regions struggled to keep pace. The same property development segment reported a negative segment profit of RMB 8,140,181, while the industry as a whole experienced a decline in new home sales nationwide, with a year-on-year decrease of 12.6%. Segment revenue also took a hit, dropping from RMB 132,709,421 to RMB 101,873,195, and profit followed suit, decreasing from RMB 15,399,594 to RMB 5,589,523. Management is expressing a positive outlook for the company, citing growth in income from property operations and shopping malls. To achieve this growth, they are focusing on inventory reduction and aligning with market demand. Additionally, they plan to intensify property management in key cities, prioritizing commercial investments and asset management. The company aims to improve its service capability by leveraging synergies between core businesses, offering customers one-stop solutions. This will be achieved through smart construction and enhanced property management practices. Overall, the strategy is centered around optimizing operations, improving services, and capitalizing on market opportunities to drive growth and success. The company has a history of rewarding its shareholders through both dividend payments and share buybacks. On the dividend front, the company has been consistent in paying out to its investors, with an interim dividend of RMB 0.07 per share in 2025 and a final dividend of RMB 0.1 per share in 2024. In addition to dividends, the company has also engaged in share buybacks, demonstrating its commitment to returning value to shareholders. In 2024, the company paid out RMB 181,367,000 in cash for shares, while issuing 54,451,730 new shares. This strategic move not only benefits existing shareholders, but also helps maintain a healthy capital structure and potentially boost earnings per share. That concludes the financial summary for LONGFOR Group Holdings Limited. Feel free to comment below, and I will be happy to answer them when possible.